How do people use whole life insurance policies as a savings asset, specifically focusing on the cash value? When you look at whole life insurance, it has been used as a savings asset for decades. When you look at wealthy individuals, corporations, they have consistently used whole life insurance policies as a means to store money, focusing on the cash value that's often their point of interest, not so much the death benefit. Although that does have a long-term benefit, it is very common to hear someone say, the reason why I'm taking this policy out is for the cash value benefit. Now, when I look at the benefits of a cash value life insurance policy, there are three core benefits in my opinion. The cash value is a safe, liquid, and tax-free area to position money. Tax-free if I don't trigger a taxable event. One example would be a modified endowment contract. The short version of that is a MEC. Now, today we are going to focus on the safety. When I look at a whole life insurance policy that is designed for maximum cash value from day one, it is a safe area to position money. Now, what I mean when I say safe, here's why people put money into these products that are specifically interested in the cash value. When we look at the safety, there's no stock market risk. Meaning when you actually look at your cash value in a pure whole life insurance product, it is not tied to or invested in the stock market at all. The cash value growth is based on the insurance company that you select, the guaranteed rate, that's the minimum floor that it can do no worse than that guaranteed rate, and then also the insurance company will often pay a surplus on top of the guaranteed rate plus the surplus result in the total dividend interest rate. Now, the net growth rate on a whole life insurance policy will likely fall somewhere between 3 and 5%. This is referred to as the internal rate of return in the industry. Keep in mind that I said net growth rate. This is the case even if you see a product that has a 6% dividend interest rate. How could I have a 6% dividend interest rate if I see online or from that insurance company, my dividend 6%, but the best I'm going to earn is potentially 5%? That doesn't make sense. The reason why is anytime you see any rate from a life insurance company on a whole life insurance product, always keep in mind that that is always a gross rate. That rate does not factor in the insurance expenses, the mortality charges, everything that comes with that life insurance product. I want to look at the net growth rate. This is referred to in the industry as the net internal rate of return. Now, going back to why people use this as a savings asset, it is a very popular product among what I like to refer to as the cash cow. This term was first introduced to me by my good friend Dr. Ace when he said, I'm kind of a cash cow, Steve. That's why he was attracted to this product. It's a great cash alternative. If I have money in the bank earning a very low interest rate or no interest at all, here's an asset that provides the same safety. Some view it as more safe as money in the bank. Banks put money into these products, cash value life insurance that is, but I can move money that is in a bank account over to a life insurance policy. Now, there are some drawbacks to this. To point out one drawback in this case, it will be the early years. No matter how well a policy is designed, I am going to take a hit in the early years. This has to do with where my money's going. When you pay any dollar amount into a life insurance policy, your money can go toward two primary areas, toward the insurance premium. Premium dollars do not show up in cash value in the first year because they buy you a death benefit. As you continue to make premium payments, those premium payments do show up in cash value. But the first area you can put money is the premium. The second area is referred to as a PUA, stands for Paid Up Additions Rider. I like to refer to this as a cash dump-in. Guess why we call it a cash dump-in? Shows up in cash value, it's money I can access, begins compounding. This is the key to accelerating the cash value growth in a whole life insurance policy. But with all that said, no matter how low I go in the premium, there's limits to how low I can go depending on the insurance company I select. I'm going to see negative cash value in the first year. What that means is if you were to pay in $1,000 into a policy and it's designed with minimum expenses, I might see anywhere between $800 and $900 in cash value in the first year, meaning I'm taking somewhere between a 10 to 20% hit. As far as the reasons why people don't do this, that's often the reason why. If someone asks, what are the drawbacks? What's the number one reason why someone would not do this? It's their early years, loss of liquidity. As time passes, the product just gets better and better. When we look at the guaranteed values and non-guaranteed values, upfront, I take that hit. As long as I have transparency around that fact before I start a policy, then I can make an informed decision, which is nice. We like to make informed decisions. Now, on the same point, as far as the product being a savings asset, it's very flexible if it's set up properly. The flexibility is one of my favorite parts. Here's why. When you hear the word insurance, let's think of life insurance. What do you think? Well, first, it's kind of boring and scary, meaning I have to pay a premium, and when I die, a death benefit is paid out. Now, if I told you that we could use this as a savings asset, a safe, liquid, tax-free area to position money, we'll see it grow with no risk over time, somewhere between 3 to 5%. Tax-free, if you're in a high tax bracket, that's fantastic. You've got the loan feature where you can borrow against it, and it keeps appreciating like a piece of real estate, your entire cash value, not just the money remaining in equity. All of these fun benefits, but it's a life insurance policy. Does that mean that you have to keep paying premiums for your whole life? Absolutely not, if it's designed properly. So we can set up a policy to be extremely flexible. Did you know that you can have a policy where you can commit just to the minimum and make additional payments at your discretion? And those additional payments will accelerate your cash value growth, meaning the additional payments you make show up in cash value immediately, begin compounding, and makes the policy better and better. Take, for example, $100,000 per year. If you said, I want the ability to pay in $100,000 per year, but I do not want to receive a bill for $100,000 per year, can I set it up where it's flexible and I can commit to a minimum amount? The answer is 100% yes. We can design it in a manner where we commit only to $10,000 per year, 10% of the desired maximum, and then at our discretion, we can throw an additional $90,000 into the policy, all going toward cash value. Now, do I have to hit that $90,000? No, not at all. It can be set up where it's very flexible. This does depend on the company and how the policy was designed, but it is possible. Now, if $100,000 seems like a lot, let's look at a $10,000 example. If you want the ability to pay up to $10,000 per year, but you do not want to receive a bill for $10,000 per year, we can set it up where you're committed to $1,000. That's your yearly commitment, and can throw an additional $9,000 into the policy at your discretion. These are round numbers. Sometimes the $1,000 may be $1,200 or $1,300. Sometimes it's a little bit less depending on the company and product. My point is, a policy with most companies and products can be designed where it's very, very flexible, minimum premium, which results in minimum insurance expenses, and then maximum cash value. So to look at some examples here, let's take an example of a cash cow first, someone with $1 million in the bank that has money in the bank because he fears another recession or market crash. He wants safety, somewhere where he can put his money where he will not lose it. And also, if an opportunity arises, he can access it. A lot of cash cows, just through experience, from my personal experience, will take advantage of down markets and of recessions. They want to be able to take advantage of opportunities, whether it's stocks at a low price, real estate, investing in business, whatever it might be. Let's take a look. So quick example we have here. On the left, we've got a model of someone moving that $1 million into a policy over 4 years. Let's take a look. Here we go. 55 years old, $250,000 per year for 4 years. We can move this into the policy faster. However, when we look at conservative returns, meaning just the guaranteed rates and guaranteed values, it makes the most sense to spread it out over 4 years. If you like technical details on this, we do have a number of videos on our channel which go into full detail. What is highlighted in yellow represents the break-even point when he actually gets his $1 million back. So what did we mention earlier was the worst part about this? Up front, negative in the early years. He pays in $250,000. What does he have here? So year one, we're at 211. We pay in $250,000. It grows to $453,000. If he was earning 0% right here, you've got 211 and you pay in 250, what would it grow to the next year? $461,000. It grew to 453. He took a hit again. It's minimal, but he's not earning money, he's losing money. What's happening is in the first 2 years of a life insurance policy, that's where the expenses are heaviest. We have them minimized as low as we could possibly drive them in this example, but they are still heaviest in the first 2 years, which is why I'm negative on my annual internal rate of return. Next year, I pay in $250,000. I get my $250 back and a little bit more on top of it. Next year, I get a little bit more, and it gets stronger and stronger as the years pass. Looks pretty good. The annual IRR represents what he is growing by each year, what his money is growing by each year, and the average internal rate of return factors in the average over a certain number of years. If we look at the 15-year average here, what do we see? Here's 15 years, just about 3.4% based on the company's present dividend interest rate and such. But we've got a cash cow here, moving $1 million into the policy, not another penny thereafter. He can continue to add funds, but he says, I don't like the idea of payments. Let me just get the money in, and then I'll use this over the years at my discretion. But it's pretty interesting when we take a look at this. So if we look at another example here to have some more fun, here is a smaller example of the $5K per year going in, or $5,000. And here's what it looks like. So to make this a little bit bigger, these examples are on younger individuals. Let's just look at a 32-year-old here. What do we notice here? $5,000 per year total going in. His minimum premium is actually a little bit less than $500 in this example, but we do want to factor in term insurance. We've got some other pieces attached, so I used a round number in this example. But minimum premium is the purpose of this. And then here's our annual outlay. Total out of pocket each year, $5,000. Here we go, paying in $5K per year. Getting his money back between years 5 and 6. Small dollar amount. Just like the $1 million per year, if we go back to the $1 million total, the $250 per year, his minimum commitment is right around $25,000 per year. Guess what this individual's minimum commitment is? Actually be a little bit higher than this, just with the way it's set up and the requirements. About $750 per year, with the option to go up to $5K per year. So it's designed with a minimum insurance premium, maximum PUA allocation, that's that cash dump in to really accelerate the cash value growth. So I hope you enjoyed this video. If you'd like some further details, please leave a comment below or feel free to reach out. We've got several videos that really go into detail, break down life insurance illustrations, and go through anything and everything cash value life insurance. But if you did enjoy it, please hit the like button, subscribe for more, and we'll talk to you soon. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.